Silver price manipulation isn't just a conspiracy buzzword. It's also a question about market structure. Here's the tension. You can open a chart and see the price of silver, but when you try to buy a coin or a bar, the real-world quote can look meaningfully different. That gap is where most confusion and most bad decisions happen. Today, I'll give you 3 takeaways. First, how the paper market, especially futures, can anchor the global reference price even when physical supply feels tight. Second, what kinds of behaviors can distort price discovery in the short run, including spoofing. And third, a simple framework to track warning signals without getting trapped by headlines. And stay with me for one detail most people miss: the difference between metal in a warehouse and metal that's actually available for delivery. The reason this matters now is that silver sits at the intersection of 2 worlds. It's a monetary metal to some investors, and it's an industrial input for electronics, solar, and manufacturing. That means macro forces, like real interest rates, dollar strength, and growth expectations, collide with supply chain realities like refining capacity and fabrication demand. Quick note before we go further: this is general education about how markets work, not a recommendation to buy or sell anything, and not personal financial advice. My goal is to help you understand why people argue about silver price manipulation in the first place, and how to separate plausible mechanisms from storytelling. Start with the core concept. There isn't one silver market. There are linked venues with different products and different constraints. Futures on major exchanges are standardized contracts that are easy to trade, margin, and hedge, so they attract the most liquidity and the fastest money. Physical silver is heavier, slower, and more expensive to move, store, insure, and verify, so it tends to react with friction. When a highly liquid futures market becomes the reference price, that doesn't automatically mean the price is fake. It means the most tradable instrument often sets the headline number. But it also creates a vulnerability. If the reference price is formed primarily in leveraged paper, short-term flows can overwhelm slower-moving physical signals. Example: imagine a fund de-risks commodities broadly because interest rates jump. It sells futures across the complex. Silver futures drop quickly. Meanwhile, a mint still needs raw material, and retail buyers may still be active, so physical premiums don't fall in sync. 2 prices can coexist: a fast financial price and a slower inventory and fabrication price. Now, where does the idea of silver price manipulation come in? It usually refers to tactics that can temporarily push prices around without reflecting genuine supply and demand. One commonly discussed tactic is spoofing, placing large orders to create an illusion of buying or selling pressure, then canceling them before execution. Regulators in multiple markets have brought cases against firms and traders over the years for this kind of behavior, which is exactly why it's worth understanding as a mechanism, not a rumor. Another issue people worry about is latency advantage in order anticipation, where certain participants are faster, see order flow sooner, or route orders in ways that improve their execution at others' expense. None of this guarantees a direction for price over months or years. It does, however, explain why you might see abrupt intraday moves that feel disconnected from headlines. If you're a long-term investor, the key is to recognize that weird tape can happen in a market dominated by leverage, algorithms, and thin order books at certain hours. So how do you tell the difference between a normal futures-driven move and a deeper problem in the market's plumbing? You look for stress signals that connect paper pricing to physical constraints. The first is the physical premium, how much you pay over the spot or futures reference for common products. Premiums include minting and distribution costs, so they don't prove a shortage on their own. But persistent, widening premiums during a falling futures price can indicate a mismatch between financial selling and real-world availability. The second is inventory reporting in warehouse categories. This is the detail most people miss. Inventory can include metal that is stored in a facility but not necessarily committed or even available to satisfy delivery. Different reports label metal differently, for example, eligible versus deliverable categories. If deliverable inventory trends down while open interest stays large, that can raise questions about how delivery demand might be met. The third is the futures curve, contango versus backwardation. A tight physical market can sometimes show up as unusual spreads, signaling that near-term metal is valued more than later delivery, though rates, financing costs, and convenience yield all play a role. Next, zoom out to policy, because this is where the free market versus strategic market debate gets heated. Governments don't have to announce a dramatic price floor to influence outcomes. In critical minerals policy, The toolkit is broader and often quieter: strategic stockpiles, guaranteed offtake agreements, producer subsidies, tax credits for domestic refining, or procurement rules that favor certain supply chains. Any of those can raise the effective revenue certainty for miners and refiners, even if the screen price still trades freely. If a government or a consortium of buyers signs long-term contracts at prices that support new supply, that can reduce the risk of underinvestment when spot prices are weak. In practice, this can change behavior. Producers may hedge differently, lenders may finance projects more readily, and industrial users may secure supply earlier. The point isn't that policymakers can repeal volatility. They can't. The point is that silver, like other strategically important materials, can be pulled toward a hybrid world where security of supply matters alongside market clearing. Who does this impact? 3 groups. First, industrial users. If they fear supply disruption, they may pre-buy, diversify suppliers, or substitute materials where possible. Second, investors. They need to understand whether they're buying exposure to a chart, futures, ETFs, or exposure to possession and logistics, physical. Third, traders. They need to respect that silver can gap on macro news, CPI, jobs data, central bank guidance, because the dollar and real yields often move the whole precious complex. For a constructive upside scenario, a few things generally need to be true. Industrial demand must stay resilient, new supply must remain constrained or slow to respond, and financial conditions must not tighten so aggressively that leveraged players are forced to liquidate. For a negative scenario, it can be as simple as growth slows, inflation cools, real yields rise, the dollar strengthens, and risk assets delever. Silver can get hit even if long-term narratives remain. Let's talk about risks and common mistakes, because silver is famous for punishing overconfidence. Volatility risk is obvious. Silver routinely moves more than people expect. Leverage and margin risk is the fastest way accounts get damaged. Futures and leveraged products can force you out at the worst time. Liquidity risk shows up in physical. The spread between buy and sell quotes can widen, and certain products can become hard to source quickly. Counterparty risk matters. In paper silver exposures, your outcome depends on fund structure, custody, and market functioning during stress. Timing risk might be the biggest trap. Being early can feel identical to being wrong, and narratives can stay true for years while price goes sideways. Also watch regulation and rules risk. Exchanges can change margin requirements, governments can change taxes or reporting, platforms can change how they handle volatility. None of that means don't participate. It means don't confuse a thesis with a risk-managed plan. Here's a practical way to approach the topic of silver price manipulation without getting pulled into extremes. Use this 5-step checklist. 1. Define your exposure. Are you trying to track spot price, trade volatility, or hold physical silver as a long-term hedge? These are different jobs. 2. Choose the vehicle that matches the job. Futures and options are trading tools. ETFs are convenience tools with structure-specific considerations. Physical is a custody and liquidity choice. 3. Size for volatility. Assume the position can move sharply against you before it goes your way, and avoid forced selling risk. 4. Use limit orders and plan exits, adjustments in advance, especially in thin hours, because microstructure can matter in silver. 5. Track a small dashboard weekly, physical premiums, the futures curve, spreads, reported warehouse deliverable categories, delivery activity versus open interest, and macro drivers like real yields and the dollar index. If you want a simple analogy, think of futures as the wholesale price billboard and physical as the local store shelf. The billboard can change instantly. The shelf changes with shipping, inventory, and restocking cycles. Mini recap. Before we wrap, silver price manipulation claims often mix real microstructure issues with exaggerated conclusions. The futures market can set the reference price because it's liquid and leveraged. Physical premiums and deliverable inventory signals can diverge from the screen price without proving a grand plot. Policy around critical minerals can influence supply and pricing indirectly through procurement and financing, even without an explicit floor. And whatever your view, the biggest avoidable mistakes are leverage, poor vehicle choice, and ignoring liquidity and counterparty details. If you found this useful, like and subscribe. This channel focuses on how the plumbing works, not just predictions. Question for the comments. When you think about silver, do you care more about the futures price, physical premiums, or macro factors like rates and the dollar? Final risk reminder, silver can be volatile, and different products carry different risks. Know what you own. This is educational, not financial advice.